Okay, yo. So daily bias. I I made some notes that I would like to go through in order to fuck is all this. Alright. In order to find a easy way to get the daily bias. And and would appreciate all of your questions. Just know if I don't see them, it's because I'm just trying to explain it on the chat, and then so just ask it all again, okay? All right, so this is some stuff from the other. Okay, where to start? Well, a bias on the daily chart is a daily bias is something that we find on the daily chart. And what we want to know as ICT traders is that we always want to see if we're bullish, trying to figure out to get into the bottom wick of the candle, or if we are bearish, we want to see if we can find the top wick of the candle. Not per se getting in, but we need to know that that top wick has been set, okay? And the reason why we want to do that is that then we can find the daily expansion all the way down or all the way up. So just for pointers real quick, you see it really clearly that you have a volume imbalance here. For example, you see that the bar open up, taps into it, creates that top wick, and from there on, we can literally just look to short it. Okay, so there's a couple of different things that you need to be to know about bias. A lot of people are thinking of bias is set in stone and can't be changed. And personally, I think that is kind of wrong because in if you know where you're wrong about your bias, then you have a chance to change it. At the same time, it's one of the hardest thing is that if you are long and you see that your trade is going against you, to close that and open a short is one of the hardest things. Once you learn that and perfect that, you will get to become a very good trader. But you don't need that from the start. You just need to know where you are wrong. And so if you are expecting a bullish day, then you would expect price to open up, go down, create that bottom wick, go up, and you can get involved all the way up, right? But what happens if you are bullish and you see price go up first and then down and then starts to go down? This is the place where you would know that you were wrong. So in order for you to find your daily bias, figure out if you are wrong or right on your daily bias, you would have to also have an invalidation place. So there is two things to a daily bias. It's a validation and an invalidation. And the way that we can validate a daily bias is to figure out where is the fair value gaps. We want to see if we can position ourselves in a fair value gap because price is likely to go from a swing high to swing low to a fair value gap, something in that order. We will get into it. I will start to try and see if I can find um, some entries at a later stage. So the way that we are looking at fair value gaps, we always need to look for a 3 candle pattern, which is just like a swing high. We'll get into it. Fair value gap is a open, displacement candle, and a close. So it's a 3 candle pattern that will create this little imbalance, this little gap of price. These gaps of prices are the places that we will look to see if we can find if long, find an entry inside of. All right. So if we take a look at price right here, this is a little harder of a place to look for a see my notes real quick. It's a little harder to find an entry right here because price has been accumulating for the last 8 days. All right, but let's take it from here. What we see is price is going up, creating displacement and creating fair value gaps. So at this time here, we would expect price to go to take external range liquidity. External range liquidity is our highs and our lows, and internal is our squares, our fair value gaps. These are the two concepts that we are going to use as well. Really simple. We mark out a swing high. A swing high is a lower high, a higher high, and a lower high. It's a 3-bar pattern, just like a fair value gap. So what we see is that we have a swing high, we are creating a fair value gap, and um, this is where we would then be bullish. The reason why we would be bullish here is just because we see displacement and movement out. So we would look to see if we can get a candle that is opening up, bearish, and then ending bullish, meaning that we wanted to tap in, open up, tap into our fair value gap, and then move. So already here in these four candles, 1, 2, 3, 4 candles, 5 candles, we already know that the next candle we will look for would be a bullish position candle. So just by using a tiny concept like that, we know that we will be bullish. Okay, so what we get another candle that is bullish, and then we get a little funny candle here that is bearish. But because this candle is creating a fair value gap that has taken out a swing high right there, meaning it has broken away from structure, we would also consider this to be holding, meaning that the next candle should be bullish. And we can look for the same pattern as this. Open, find the bottom, go long, and then it will close to create that top wick up here. Same as the next, we get a big displacement out. We will look for another bullish candle. We get that bullish candle, but we don't get any fair value gap. There's no displacement. In this particular time, we will have to sit and wait. We can either look for entries on the previous fair value gaps, but since price has not really shown any displacement, any power in actually showing that price want to move further up, quite the opposite. Then we will be careful and we will have to wait. What we could have done is that we could have gone back in time and we could look if there was anything else. This is all-time high, so we know that there won't be anything else. Now what we then see is that there is no displacement up. There's no fair value gap. So we get a big bearish candle. Okay, let me just have a sip of coffee. A big bearish candle. That bearish candle is taking out a lot of candles at the same time. What we then see is that we have our fair value gap. We tap into it. So what do we want to see when we get into these areas here? Well, we want to see if this fair value gap is going to hold. We would want to see it to actually give us displacement out. We want to see a candle like this, massive gap in it as soon as it taps it. We don't see that. The same time, if price closes below that 50% of the fair value gap, then we already know that we might actually want to start looking bearish because it's not respecting the fair value gap. So we see this massive candle here, and we're staying on the sideline because we know already up here that there is no displacement. So we would have to wait for another fair value gap that we actually can trade. We tap into it, and we actually tap into this one here below as well, respecting that, taking out liquidity. So from here, we could argue that we are a little bit bullish. What we also see is that we see a volume imbalance being made right here. Those I think is really, really strong. So we would be bullish out of this candle here. We get a bullish candle there. And then the next candle, this one here, I would look for longs in this volume imbalance. Let's try for the fun of it and dive into the 15-minute chart and see with our sessions and see if we can actually find some entries. So our volume, wait, let me just see, our volume imbalance was created on the 15th of July. And so here, okay, so it's created there. We don't trade it here. It's late in the session. London comes in. We know that we are bullish off of this volume imbalance. So we would have to look for longs. We won't just look for longs anywhere. So we would look for a London reversal. This is a London reversal. And the way that we could implement this is just to wait for that 15 minutes to give us the change in state of delivery. We have it right here. We take our high of the order block, close above it, and what do we see? Just as when we're finding a bias on the higher time frame, we're doing the exact same right here. We see that we come down, we tap our point of interest, our higher time frame point of interest, we push up with massive displacement compared to on the way down. You see that there's no displacement into the level, meaning that price's volume is kind of dying off. But what we do see is that we see displacement out of it, closing above that high over here, closing, making a change in state of delivery. At the same time, we have our fair value gap. And we know from finding the daily bias, it's the same on the 15th. So we know that we can look for a long here because on the daily bias, we know that we want a long from the daily volume imbalance. So let's say that we get involved around this area here somewhere. So where would our invalidation be? At least to the high here, or if we go to the daily, once again, on the daily we go from external to internal. So here we have taken external, creating internal, made internal. So our invalidate or our draw would be this high here, eventually this high here. If we fail to get that, then we know that that would be our invalidation. Okay, so this up here would be the high that we would aim for. It would give us a great risk to reward. Do we get that? Now we can just dive a little bit deeper into it. Let's just remove all the noise. Because at the same time, if I were to remove this 15 right here, so you couldn't see that this was the 15-minute chart, this could just as easily be the daily. All right? Because it's the exact same on the higher time frame and the lower time frame. So what we see is that we take the high. What do we take the high with? Displacement. Okay? So we would assume that this holds, and we are still correct in our sitting in our long from either the fair value gap or just higher, wherever you just feel comfortable with your entry function. All right, when can we look to get out of this long? Well, we would want to take this high. We take that high, but we also take the low. This is where we start to see that we might actually be wrong on the bias. And so the reason why is that we don't see displacement out of it. As soon as we tap our volume imbalance down here, We get a massive candle of displacement, another one with displacement, and here we're just ranging. We get some news. We might be out because of news. Let's just say that there was no news. We then are gonna look into what is run and sweep of liquidity. A run on liquidity would be that we were closing above with a fair value gap, with displacement up above, showing the price really want to go higher. Okay, let me show you in price. Here we see that this is running this high with displacement. That's a run on liquidity. And right after we see a sweep of liquidity. This right here. It goes up above and it closes down below, meaning that there is no volume, there's no displacement, there's no reason for it to actually go that much higher. And we can do the same over here. And let's just, for the fun of it, go to the hourly. The hourly, you see it very clear. Up, down. So this here, failing to close above right there is already where I know that I would start to say, well, my daily bias might be wrong. My daily bias of just going long into this might be wrong. And this is my invalidation, okay, that we're actually showing that we are going lower. Okay. What we then see after we sweep that, we see that we make displacement to the downside instead. Change in state of delivery. And then we really know, okay, well, I was wrong on the day. Maybe we actually need to go and look and see if we can find some shorts. So that whole idea I was trying to tell in the start about where, about it's okay to be wrong on the daily bias. And the bias is not set in stone. We just need to know when we are wrong. And you can be really, really wrong on the 1 minute. I can't go that far down. So if you stick on the 15 and stick to it, and the low, like your lowest time frame of finding bias for the day, you'll be golden. You'll actually see that around that, like a 15-minute change in state of delivery in London and New York, either way, is such a high power move that you actually can use that every single day to see, okay, well, the 15-minute changed its direction, reversed. Let me get on that side. You see it right there as well. Could find a short into it. See, this is a little harder right there. You're coming down, down. Okay, that's also bad. Here, coming down. Change. We close above, coming back down into the fair value gap, and we're going up. You see what I mean? All right, getting lost on the lower time frame. We were supposed to be on the higher time frame. That was where I wanted to show. All right, so can I repeat what I just said? I'm recording it, dude, so you can just go back. It might be going a little bit fast for somebody. Okay, on to the next, because we want to see if we can find our bias here, okay? And what we're already starting to know, we knew that on the lower time frame that this candle here, this volume imbalance, is not gonna hold for higher. So we were looking for shorts on the next candle. Let's just try and do it like that. So we would look for a bearish candle, and we get that. What we see now is that our bullish point of interests, our bullish fair value gaps are being disrespected, and price are going down instead. So once you inverse what is going bullish or bearish, you inverse that, that could already be a sign of going lower, because you're disrespecting bullish price action and you might be starting to respect bearish price action. So we get this massive bearish candle. We are actually going straight through. So at this point, I would be looking for this low right here. So my next thought would be that we will get a bearish candle. If we are gonna get a bearish candle in the next, we would have to look for an open, a high, low, and then a close right there. Meaning that this next candle will have a top wick and then go down. Let's see. All right, so we open, we go up, leave this here. Now the next candle, I would look for the exact same. The reason is that we have a fair value gap right here. We have inverse these. We can just take away these just to make it a lot clearer. This is how I would find my bias, okay? And so we get this fair value gap right there, and I would look to see if we can get price to do something like that. Go straight up into it and then push down. That is what I want. I want a bearish candle. Okay, we don't go up into it, but we get a bearish candle. Let's go and examine that bearish candle and see if there was a reason for us to get positioned in that high right there. So we go in the lower time frame. We would need to have our opens up. Let's go to the 4 hour real quick. And you see what? The 4 hour created a fair value gap. And that fair value gap broke away from this low. So just by having this low being broken with such big force, we would actually think that this will hold over that daily fair value gap up here. So if we were not considering the higher time frame, or we were considering because we were looking for the shorts, we would know that this 4 hour right here is a place of looking for trades. And if we go all the way back into that, we see a perfect Asia sweep. Yeah. So Asia come up, London opens, take out that high, and then it pushes away. And then at the same time, we have that 15-minute change in state of delivery right here that you actually see right on the NY open as well. You see they failed to close above, and so coming into New York, we might be more bearish than bullish, and we would just wait for New York to actually close below a swing low. So you have that swing low, you have the next one as well, you move it up, and then you get into New York and you close below and you start making these massive wicks. And the thing about this is that we have no fair value gaps. So we would sit on the sideline all the way down until we see a fair value gap coming out of it. This is where we get involved. Right? So do you guys see how I'm using my daily bias to actually try and predict where to get involved on the lower time frame? Let's take some more candles here. So we are respecting that 4 hour fair value gap here. We are going down with force. We're closing below here. We are running liquidity rather than sweeping liquidity. So what I would look for next is a bearish candle in the sense of I want to see a place where I can get involved and get a trade in the high of the wick. Okay, you see right there we get the exact opposite. Let's see on the lower time frame if our bias was wrong, and if so, if it was wrong, where could we have invalidated it, our bearish idea. So let's see, this is the 22nd of July we're looking for. 22nd of July. Okay, so right here, right now, we see that Asia opens up. This right, this here is literally looking like the day yesterday. There's like 1 to 1. If you go and look, just for the fun of it, what was the 15? So much shit here. Okay, look at that. Yeah, let's just delete all of this noise. Going up like that. Do you see it? What time did it reverse? 11? 11-ish. I think that's fun to look at. So on the day, we were looking just by looking on the daily candles, we were looking for that bearish candle, and we wanted to see if we can find a high to get involved to get into a short. And that would then mean that throughout London, we see that we're just pushing up, and we know that we want a short, but the 15-minute is not really giving us any short entries. It's not giving us any change in state of delivery. So even though we are wrong on the bias, we wouldn't really have gotten involved if we were just staying with the 15-minute. Because here you see we don't close below here. So that's not a place where we could get involved. We take the Asia high. We don't really close below here either. So price is not showing that it want to go down. It's just continuing up. And this is one of the places like why we had so much difficulty yesterday trading, is that we need to just press that buy button and get into it. What do we see? Well, we see the price go and take that previous day high. After that previous day high, and we're still bearish on the day, remember that? We would then look for our short to drive us into the lows here. And you could say that we closed below here and we're starting to push down. So this might have been a loss right there. But at the same time, when seeing grinding up like that, knowing that yesterday the same as well, we wouldn't really expect when price moves like that to go and take the low. So on one side, I would probably not really even look for shorts here, not on the higher time frame. If we could go to the 5, we can. Maybe we could find some entry here on the 5-minute chart. That doesn't matter. I'm just trying to explain how to use the daily bias and how to invalidate it. You know what I mean? All right. So what we're seeing right now is that we have a fair value gap up here. We want to see when price is not creating on the daily. What's happening with NQ? Yeah, all right. It's just pushing up. It's doing the same as yesterday. All right. Are you guys with me still? Do you get it, or do you think it's really complicated? What up, Corey? Not complicated. No, because it's literally just two concepts. But I wanted to, if it was complicated, I wanted to just try and see if I could explain it in another way. All right, so we have a fair value gap right here. And so that's the thing about a daily bias, is that we can get like, so if you look here, we would have thought that we wanted to long that fair value gap, but we continue down into it. There's not really any fair value gaps coming out of it, so we can't really trade. So what we wanted to, we can trade, but we can't trade the daily bias per se, because this here isn't getting tapped into. And we do tap into this fair value gap here at a point, but that's like one, so 1 and 2. Okay, that's a bad example. This might be better, because we're coming from this, coming from that. That's also a good example. Fuck. Okay, we might get it. Let's just continue. Oh, I wanted to. All right, so this candle here is closing with displacement below the low, and we would have to expect a bearish candle after that. We want to expect, if we want to expect a bearish candle, we want to see that open, up, down, and close. Okay? See, we get it. Open, up, down, and close. For the fun of it, let's dive into that candle. Let's see what time it was. It was the 25th of July. And let's see if we could have got involved in that, because this is actually looking a little bit harder on the lower time frame, because it right here we can't see, but it opened, created the low, top, and then it closed below. You can see it right here. 18 here. Open, low, high, and low. So that is a hard candle to trade, but we already know that we want to position ourselves in the high of that candle. And so throughout the whole morning, we would consider, because the open of the candle is here. So right there, we have created that top wick. All right, let's just put on this one. You can actually see what I'm trying to say if we go like this, and we go, we go to the open. So now we have the open of the candle. There's no wicks on either side. We go through, you see that Asia is starting to create that top wick. Let me just zoom in a bit. Asia is creating the top wick. Closing below. Now we have that top wick. And what did we say? We wanted to look for a bearish candle. So throughout London, all we need to do now, because we know that top wick, the high of the day possible, could be set already. There's a possibility for the top wick to be set. All right, I'm already rambling. Half an hour. All right, we can go a little bit longer. Closing below. So now we know that we have our change in state of delivery, and we would like to wait for London Open to find trades. Okay, London Open. So London has put in that top wick. Until we close above that, we would consider only looking for shorts because we are short on the day. The top has been made. So how do we find shorts? Well, we can already see that it's failing to close above the high. So now we know that if we know already that the market order flow is bearish. So we just need a bearish fair value gap that we can actually trade into. There we go. We have a bearish fair value gap. Let's see if we get screwed on that. We do. Almost. Invalidation would be the high here then. Start to play around. So all London, we were looking for shorts, right? You see this massive move right here from the high to the low is 212 points. You could probably find a trade or two in that for going short, especially because you're considering that we're not going to take this daily open once again. Going into New York, we'll see that they fail to close below here, and we might see some upside. What we want to see for our bias to be playing out is that we want to see a massive wick on the high to hold. All right, we see that they close above, they fail to close above, and then push down. Fair value gap, displacement, and then now you see they come back up as we talked about, creating that top wick once again. So this is one of the more complicated days, in my opinion, to trade. All right, next candle on the daily. What would we consider? Well, we can consider that we are in a fair value gap here. We're closing above. But at the same time, we are just pushing down. So now we have two point of interest that is actually going against each other. So what would be the most likely scenario? We can do two things. We can sit out and wait, or we can look for that next bearish candle. All right, it didn't come, but we're respecting that now. Then maybe what we can do now is that we can look, see if we can find a bullish open, bullish, and then up into that fair value gap to then close out. Open, down, just about tapping it, and then it just melts. Now we're disrespecting this here. So now we want to look for shorts once again. Okay, we don't get it. So let's go and inspect this one candle here, the 31st, and see if we, with our short bias, would have gotten screwed. 31st. Somehow those days where it just moves are looking a lot like, you see this here? See that there? It's the same days. So for us to be short in this day here, because we knew that we were short, we would just literally not have done anything. Because here, the first time that we actually get a entry function for shorts is all the way up here, and that's in lunchtime New York. So this would just have been a day where our bias was wrong, and we wouldn't have done anything. We would just have sat on our hands, waiting for that short opportunity that never came. Now, where's our invalidation of this then? What I think of an invalidation is that as soon as they go up above here and they close on a higher time frame, that is a place where this is the previous day high. As soon as they close above that, we already know, okay, maybe our bias was wrong. And this is just one of those days where it's really hard. We have to get involved somehow, somewhere. On the 15, we have a fair value gap right there on the weekly, flipping that weekly candle. And that brings me into to bias and considering the weekly, because what you see here, let me remove that and put on the weekly. Let's remove the daily. So what you see is that the weekly opens up out here, uh, out here. It creates a top wick, it goes down, create that bottom wick. So now if we can figure out finding a place where we have drawn into at the low of the week, that we can put some validation towards it being done below, then we can just start looking for higher to create the top wick as they're doing now. And then we know that we are in this fair value gap here, the daily fair value gap, failing to close above. That means that now they have put in the bottom wick of the week, and they also have put in that top wick. So we can look for the next day to be bearish. And it was. Does that make sense? Back down. Look at the sessions. We know that we want to see if we can short from this daily fair value gap because we were bearish on that day, creating that top wick on the weekly. What do we see on the 15? Let's just remove that. We know we want to short. On the 15, we take out that high in London Open. We have massive displacement down with a fair value gap. Change the state of delivery. Right there. Stop hunt. Breaker block. Fair value gap inside of the breaker block. What is this entry function? It's a unicorn. 2R. 10 points. Whatever you want. What I'm trying to show you here with this, why I'm going to the 15-minute, is that a 15-minute change in state of delivery in London usually holds for the rest of London. Or kind of, so here you have, here you have this change in state of delivery, and from here you're bearish, right? We go up, we make a stop hunt, you're still bearish in this point, coming from that daily fair value gap, so we're still just looking for bearish. Now all of a sudden here we see a reversal. 15-minute displaces up, taking out the high. You can count on this to hold. And it does, at least in the sense of trading the fair value gaps, 15-minute fair value gaps for the rest of London. So 15-minute is just such a strong time frame to look at when combining with the session highs and lows. Let me just go over my notes and see if I got everything. Okay, I actually think that I have. One thing that I wanted to just touch on real quick is the rating of fair value gaps. Because all this really comes down to is just finding a fair value gap and trading it. So we would want to see from the start, we want to see fair value gaps being traded from as long as they have run liquidity. So, in my opinion, and what I feel like I've seen a lot is volume imbalances. If we trade into them, it's gaps in prices. In my opinion, they hold more value in order of continuing order flow than the than a normal fair value gap. So if price would have moved up into here, I would expect it to hold. After that, we get a fair value gap. That's normal fair value gap. But the reason why this fair value gap is better than the next fair value gap I will explain is that we are bearish. We see a bearish closing candle with a bearish closing displacement candle and a bearish ending candle. It's a three bar pattern. Yeah, same as over here, but opposite. Here we see a up close candle, bullish candle, the bullish displacement candle with a up close candle, bullish candle after. This fair value gap is higher priority than this candle, this fair value gap. The reason is that, or this one here, next one. And the reason is that we have a bullish candle, bullish displacement candle, and a bearish candle, indecision candle, and the same on the next. So this is just a little bit lower priority, or I will, when I see that in price, I will know that there is less likelihood of that holding than price actually coming into something like that to hold. That's the rating of how I rate my fair value gaps. But we also see that on top of that, if you have a fair value gap that takes a high, this is called a breakaway gap. That is even stronger. So volume imbalance, breakaway gap, um, three-sided gap, and then two-sided gap. Do you guys get that? The idea of that? All right. So this is how I look for my bias. And so if we go to yesterday's price action, the bias was really powerful because we were looking at one thing. So you can literally see it here. What we see is that you have a up close candle, down close candle. Didn't hold. Up close, up close, up close. Did hold, right? Go down in lower time frame. If you saw my video from yesterday, um, you'll see that my bias was the 4 hour, wait, 4 hour fair value gap with the AM session above it. So let's see, I think it was that. Yeah. So that's for London, was my first bias, and then eventually previous day high, which we took, and then we just literally melted from there. Didn't trade PM session, but throughout London here, even though we never really got a displacement, we knew that we wanted this fair value gap to hold, and Asia had told us already that it really holds. And what we see when the Asia sweep strategy didn't hold, and the reason is that we had displacement up above. We didn't have like a massive wick, we had displacement up. So from there on, it was just literally finding those fair value gaps to try and see if you can find an entry function up. Didn't tap that one. Okay, well then, so what happened next is that there's a tiny one there. Is that our drawn liquidity was met, our AM high with our 4-hour fair value gap. At the same time, we had that monthly open, the red line here. So I was considering, well, the monthly has already put in that top wick, and then it went bearish, putting in the bottom wick. Does it really want to go higher? And then when we were here, I was like, nope, let's see if we can find a short off of that. And we had a bearish fair value gap to trade from. And if we were just to enter blindly on that, we had 33 points that we actually could have taken out of that one trade on one contract at $600. And I only go for 10 anyways, base hits, you know? So that is the way that I mix and match my bias from the higher daily time frame to the lower. There will be days where the higher time frame, the daily time frame, won't really give you any entry functions, and it would just range like this. You would have to wait for a fair value gap to be created to know that you're on the right side. In those times, you can't go down into the 4-hour, because the 4-hour you see already there is no fair value gaps out of it. But what you see is that on the 4-hour, massive fair value gap, and you will try and see if you can go short in this range here. There's also a lot of possibility to get fucked right here, and you have the same here and the same here, and that kind of invalidates. All right, does any one of you have any questions? Let me know. Otherwise, this would be it for today. Hope you enjoyed the session. Mm, let's see. Note. After the 15-minute fair value gap, you take the entry direct or wait for unicorn on a 1 minute 15. Yeah, so I would always wait for my entry function push, because so we were talking about this trade here, yeah. Boop, boop. Fair value gap in here. Let's see. 1 minute. This is what I would trade. The breaker right there. Um, and to the low you had 25 points. And you can go in the volume, and you can watch the video. I think I go over this trade or one of the other I took out here. But yeah, I would wait for an entry function. I wouldn't just short anything blind or trade anything blindly. And you'll see if this fair value gap will hold once they tap into it. You'll see on the lower time frame that it gets that volume spike, showing that there is intention in actually using that fair value gap. At the same time, when price fails to close below here, when we come up into it, are already on the fence of either going break even, getting out, because price is gonna most likely move higher. Thank you, Raven. As if I am not wrong, it is happening on NAS from the 15th of August. If it close above, not. Can you rephrase that question, Kush? You see it again. We close above here. What do we close? What we do when we close above? We do it with displacement, a lot of volume, fair value gap right there. What time is this? 10:15. Could look for an entry in that. See, break a block, close above, entry, unicorn, long. Try and go for that high. We get that high. Money. Simple. Didn't take that trade. I just wanted to show how much value you can put in a 15-minute fair value gap. I got the answer. All right, cool. All right, I will wait. I got the. I probably wouldn't look for it to close above and then go long off of it. I would go long off of that fair value gap as well. All right, guys. Thank you very much for coming, for stopping by. I hope this video really helped you a lot. Otherwise, you can just ask questions. All right. Have a great one.